Hello everyone,
Welcome to Edupedia World.
I am CA Radhika Singh. Today we are going to start a new topic, capital structure. So as the name suggests, it is the structure of the capital of a company. So capital comprises of equity, debt, preference share, retained earning. And the structure of all these forms, or you can say what proportion these sources are there in the total capital, the weightage of each source represents the capital structure of the company. So capital structure is nothing, you can say it's a breakup of the capital employed. So if we say that a company has a debt of 32% and an equity of 68%, I'm talking about the capital structure of that company. At what proportion the debt and equity is there in the company. Defining this capital structure or designing this capital structure is a very key tool of the management. And it's very important because this capital structure ultimately represents the investment and you can say the financial strategy of the company. If the company wants to grow faster, the company needs more capital. In such scenario, the company could raise funds from the debt, or you can say the company could raise the funds from external sources of the finance instead of raising it internally. Apart from that, it also describes that what type of company is there, or you can say the nature of the risk profile of the company. If the company borrows from some funds from outside, it also increases an obligation of the company, interest burden, right? So that will somehow increase the financial risk over to the company. So a risk lower company will increase, or you can say will expand by raising debt. However, a risk averse, or you can say a conservative type of a company will prefer to raise the finance through equity. There's a very other significance, or you can say of capital structure also. Say if a company has a good operating profit, that company could incorporate debt because it could bear that financial burden, or that burden will also help the company. How? Because that interest is tax saving. The company can claim deduction over that. Capital structure of a company could also act as a tax management tool because interest on the borrowings is tax deductible. Moreover, you can say that if a company has higher operating profits, that company could incorporate debts into its capital, right? Because it could bear or it could take the financial risk. So capital structure is very important to be defined and to be designed very carefully. Capital structure of a company could even act as a tax management tool. Capital structure of a company could also act as a tax management tool because the interest on the borrowings is tax deductible. So we can say that if a company has higher operating profits, that company could incorporate debts into its capital because it could actually bear the financial risk or it could take the financial risk. So capital structure has a great significance. This capital structure is not same as the financial structure of a company. So by finance structure, it refers to all the components of the finance in an organization. So capital structure is just a part of the financial structure of a company. Capital structure consists only of the long-term sources of finance. While in financial structure, it consists of all the assets, the liabilities, and the capital of a company. So capital structure is just a part of financial structure. So if we look at the balance sheet of a company, in that balance sheet, the entire left-hand side, which consists of the capital, current liabilities, that is called as the financial structure of a company. And if we just talk about the capital of the company, we talk about the capital structure of the company. So to explain, like this is how the balance sheet of a company looks. So in this, if I talk about what is the capital structure of the company, so the total capital consists of 3,30,000. Equity, retained earnings, debt signifies the capital structure of the company. and the total 3,90,000 represents the financial structure of the company. The financial structure of a firm is considered to be balanced one if the amount of the current liabilities is less than the capital structure net of outside debt. Why? Because in such cases, the long-term capital is considered sufficient to pay the current liabilities in case of sudden loss of current liabilities, or you can say sudden loss of current assets. The long-term debts are enough or sufficient enough. The financial structure of a firm is considered to be the balanced one when the amount of current liabilities is less than the capital structure net of outside debt, because in such cases the long-term capital is considered sufficient to pay the current liabilities in case of sudden loss of current assets. Now, this capital structure could be in various forms, like a company could have more of debt or it could have more of equity. Basis this, capital structure is of four types. First, horizontal capital structure. That means all equity. When the company introduced only equity into the business, and for further expansion, it only prefers or goes for equity. That the capital structure consists of only one component, that is equity. Such structure is called as horizontal capital structure. So this is a very stable structure since there is no financial risk into the company. The company is expanding only through the retained earnings or the equity shares. So there is no financial risk or external source of finance which is there in the total capital of the company. The other one is vertical capital structure. Well, it does not mean that it consists of or it comprises of total debt. That could can never be any scenario, because without introducing your own capital into the business, a company cannot raise funds from external. A company has to keep a small amount, but the foundation should be a small amount of equity, right? So a vertical capital structure is a one where the company start with a small amount of equity, and a large chunk, or you can say the major portion, consists of preference share and debt, that is through external sources. And if the company wants to expand with such a capital structure, the company prefers to expand only through debt. So such type of structure, you can say that is a very risky structure because it increases the financial risk, the fixed obligation onto the company. The other type of structure is a pyramid shaped capital structure. So by pyramid shaped capital structure, in pyramid shaped capital structure, the major portion, or you can say the foundation of a capital, is through equity, and there is a very small portion of debt. So the cost of an equity and retained earnings is more than the cost of the debt. Such type of capital structure is preferred by the companies which are risk averse, or you can say the conservative firms, those who do not want any financial risk. And if such type the company wants to expand, they expand by raising or issuing equity shares, or you can say by reinvesting retained earnings. So such type of companies do not prefer to pay dividends, they like to retain it into the business. The last one is inverted pyramid shaped capital structure. So as the name, it is completely opposite of pyramid shaped capital structure. So in pyramid, there is a major portion of equity. In inverted pyramid shaped capital structure, there is a small portion of equity and there is a major capital structure, or you can say a superstructure of debt. In this structure, the cost of capital and retained earning will be less than debt because debt portion is more. And if the company has to raise or wants to expand, so the expansion is financed through debt. So if a company has such type of capital structure where it has a very low base of equity, it's a very risky structure because there's a huge financial risk, and such structure could easily collapse because there is a more fixed obligation over to the company. Now the question is that which capital structure is actually optimal for the company? Which capital structure is best? There is no ready-made capital structure. It depends upon the nature of the company, the management nature, or the strategy, how the company is actually progressing, the liquidity into the company. So there are various factors which actually affects the capital structure of the company. But the optimal one, see, why the company is actually forming this capital structure. What is the basic? The company has to minimize that cost and actually has to maximize the profit. The company do not want that such a capital structure will be built that affects both these goals. So we can say that a capital structure or a well-planned capital structure is the one which has long tenure. So by long tenure it means that you do not need to disturb, right? If a company has a planning that the capital structure of a company is 2:1. By 2:1 I means twice of debt, like 200% debt of equity. So if a company has 100 rupees of equity, company has 200 rupees of debt. If I'm just giving an example. So if a company has this type of capital structure, this capital structure should run for a long tenure. The company is not disturbing this capital structure in a very short span, or you can say project wise. So optimal capital structure is the one which can state, or we can actually stand in various situations for a long tenure for the company. And apart from that, consistency into the company. By consistency, the same formation of the capital structure, and which is actually practical or feasible to run in. Like more of debt or more of capital, like whatever the structure. So the basic idea is only the maximizing the market value per equity share, which is the long-term goal of the company, and minimizing the overall cost to the capital. The optimal capital structure of a company is the one which supports the objective of the company. So objective is like which is in tune to both the long-term and the short-term objectives of the firm. So what is the basic objective of a company? To increase its value per equity share, that is to maximize the wealth of the shareholders, right? And how they can do it? By minimizing the overall cost of the capital to the company. That is the objective. So a capital structure which is in tune or which actually helps the company to achieve these goals is an optimal capital structure. So how an optimal capital structure? An optimal capital structure should have these three qualities. The first is long tenure. Long tenure means like it should at least that capital structure should cover the working of at least 5 to 7 years in a project. Expansion of the capacity, addition of the product lines, etc. That should be accounted for that plan. Next attribute, consistency. By consistency I mean the planned capital structure, it should be consistent with the overall financing philosophy of the firm. If the firm has a risk averse policy, then the plan should have minimum component of debt. Vice versa, a risk lover should have major portion of debt. Third point is feasibility. The capital structure cannot be impractical. It should be workable within the amount of the share capital, debt and retained earnings, which is expected to be available into the company. So these three attributes should form an optimal capital structure, or you can say should be there in an optimal capital structure. An optimal capital structure is the one which helps the company to achieve its objective. Now, what is the objective of the company? To increase its equity value share. And also when we raise the finance, what is our objective? We want to raise those finance at the minimum cost of capital. So a company or a capital structure which helps the company to manage both these objectives is an optimal capital structure. But besides that, the capital structure should also be of long tenure, it should be consistent, and actually should be feasible. So by long tenure means it should cover the working of a project for 5 to 7 years. So if there is any expansion of the capacity or addition of product lines, that should be accounted for in that plan itself. By consistency, a capital structure should be considered with the overall financing philosophy of the company. So if a company is a risk averse, or you can say is a conservative risk policy company, with that philosophy, the capital structure should consist of least amount of debt, and vice versa. If there is a risk philosophy of being risk lover, in such scenario, the capital structure comprises more of debt. And third factor, feasibility. The capital structure should not be impractical. It should be in line with, or you can say it is workable within the amount of share capital, debt, and retained earnings which is expected to be available into the firm. So, forming a capital structure, there's like what component should be there? There are various determinants to form that capital structure. As we discussed, the company has to minimize the risk and maximize the profit. This is the basic objective. So we already studied in the cost of capital. If the company wants to raise a funds, which two factors will be considered? What is the basic two determinants? Minimization of the risk and maximization of the profit. Apart from that, nature of the project. What type of project is there? How long will it run? All these factors will also contribute in determining the capital structure of the company. And the fourth one, control of the firm. Control of the firm is very important because, see, if a company raise all the funds through equity, that will somehow dilute the control of the company. Dilution of a control could even lead to a risk of takeover. So a capital structure should be formed in such a way that it actually does not dilute it in such a way that it could be takeover. There is a risk of takeover over to the company. By nature of project, I could explain further, like a project, you can say an infrastructure company which has a long gestation period. Such a company, while raising funds, should keep the factor like how long the funds will be needed. All these things will determine the capital structure of the company. In the next class, we will study more about that how this capital structure compute, how it is designed. Thank you so much.